Interest rates have climbed 100 basis points in the last 15 months, and it's become increasingly difficult to acquire assets at below replacement cost. How would you deploy this? How would you deploy capital today in this environment? And what are your projections over the next 12 to 24 months for interest rates and cap rates? Joe?
So I think just simply from reading what others think, because I'm not smart enough to know where interest rates are going on my own, it seems like everybody, the consensus is they're going up. There's a call for more rate hikes this year and a few more next year. Question is what's going to happen to long-term interest rates, because that's typically what fuels the real estate returns. Not much of real estate is bought on the short end of the rate curve. Most of it's on the long-term end of the rate curve. So on the one hand, with rates moving on the short end, you would think the long end would move, but it may not, which would be a bit odd and something we haven't seen before. I do think the long end will move a bit. Therefore, I think conventional wisdom would tell you that cap rates should move up because people can't afford that. However, there is so much money trying to get into real estate and trying to get into Canadian real estate particularly, that I think people will adjust to a lower return. And I think you're seeing a lot more, especially pension fund type investors, institutional, who would say, I'm okay not to use debt and I'll just take my returns on a completely unlevered basis because I still can't get the returns I can get in real estate. It's a hard asset, I'm comfortable with it. So I actually think that even if interest rates move materially, it's not going to have a huge impact on real estate values. I don't know that we're going to see significant growth in real estate values over the next little while, but I don't see any reason why we should expect them to fall.
Armin, I know that you served as a director on the Board of Canada for a number of years.
Bank of Canada.
Yeah. What's your view on interest rates over the next 12 months?
Well, that doesn't make me an expert because, as I said, even the governors of the Bank of Canada and the chair of the Federal Reserve will overreach sometimes. But right now I'm taking them at their word. The Fed says they want to raise 4 to 6 times in the next 18 months, and I believe they want to, and they will if they. And the Bank of Canada says 3 times at least. So the short-term rates are going up. In fairness, they will pause if they see some bad economic numbers. They'll pause, and for 1 quarter we won't get a rate hike. But they're hell-bent on raising rates so that they can lower them next time there's a recession. But they're the ones that will cause a recession. Now, hopefully the bond market doesn't cooperate. To Joe's point, for us in the real estate business, as long as the long-term bonds don't rise just because short-term rates are rising, that's good. But then you get this inverted yield curve, and that's a screaming signal that recession is around the corner. So I'm a little bit pessimistic. I'm concerned that the central bankers, they want to raise rates just so they can lower them, and that's not good enough reason for me. I'd like to see our economies run red hot for a while. Let us just run red hot for a couple of years. Let the middle class and the blue-collar class income group, let them create some more wealth, let them get ahead in life and make some progress. The high net worth individuals, they can always find a way to make money in a downturn, but the masses, we're seeing a gap there that's bothersome. Central bankers should be aware of it. But to your point on yields, we're developing to own now because development yields on a risk-adjusted basis give us higher returns, newer generation real estate, and it's paying off. I would do that for almost all asset classes. Buying is easier, but the real estate in Canada in particular is priced to perfection. But if you want to have fun, and Peter would know this more than me, you can go to Hong Kong and pay a 2% cap rate on an office building where the rents are $100 a square foot net. Your debt costs you 3%. Your return is guaranteed negative. Well, it all depends. Your return is either 2% to -1, depending on how much debt you use. But it's still happening. Those transactions are still taking place because they believe in the rental growth. And so far, they've been right.